Let me say something that might bother a few people. If your real estate deal can't raise capital right now, it's probably not the market. Because here's what's true at the exact same time. Sponsors are getting funded this week. Investors are still wiring money, and great deals are still happening. So if your raise is stalling, it's not because nobody is investing. It's because investors are doing what they always do in uncertain markets. They're filtering harder. They're underwriting harder. They're looking at deals closer. And if your offer just doesn't feel clear, credible, and compliant, they don't want to argue with you. They just pass and move on to the next one. Today, I'm going to tell you the real reasons capital raises die and exactly how to fix them. If you're a sponsor, a fund manager, or capital raiser, and you've been thinking, maybe I just need to wait until rates come down, I want you to hear this. Waiting is often just a socially acceptable form of avoiding the real problem, because down markets don't kill capital raising. They just expose weak capital raisers and weak capital raising. Here's the story I hear all the time. Investors are scared, money is tight, no one's writing checks, the market is impossible to raise capital right now. That story feels great because it removes responsibility. It feels good here, it's not on you. But capital doesn't disappear, it just reallocates. Over the last 13 years, I've built over 700 funds as a securities attorney and capital raiser, representing over $9 billion in transactions and over $3 billion in capital raised. So I'm not guessing here, I'm telling you what I see and what I know. In markets like this, capital moves away from uncertainty, weak operators, sloppy structure, unclear messaging, and towards sponsors who look like the safest pair of hands in the room. The market isn't closed, it's selective. Most deals don't fail because they're bad deals. They fail because the sponsor confused having a deal with being investable. They think returns sell deals. They don't. They think a spreadsheet closes investors. It does not. They think if they sound confident, people will trust them. But investors aren't buying your IRR, they're buying certainty. And certainty comes from three things: clarity, credibility, and compliance. When any of those are missing, the investor says, cool, let me think about it, and then you never hear back. But here's what they're actually thinking. Here's the internal conversation every single investor is having, even if they never say it out loud. Do I trust this person? Not, is this a 16 or 18% IRR? They're asking, have you done this before? Do you communicate like a professional? Do you understand the downside risk or just the upside marketing? Are you buttoned up or are you just winging it? What happens if things go sideways and go wrong? What happens if interest rates go up instead of down? Most sponsors don't answer those questions. They jump straight to the numbers, and the investor's brain does what it always does when something feels unclear. It stalls, they ghost, they say circle back with me after the beginning of the year. That's not a no, but it's uncertainty. Let me give you an example. So example number one, the sponsor who thought a great deal sells itself. I see this pattern all the time. A sponsor has a legitimately decent deal, a good location, conservative assumptions, fair terms. They even have experience, but they launch the raise like this. They post it on social media, they run ads, they text a few people, maybe they send a pitch deck, and they expect the money just to show up. Then the objections start rolling in. What happens if occupancy drops? Are you protected from debt fluctuations? What's your track record with this exact business plan and this asset type? Who else is in business with you? Can you even talk to me about this legally yet? Those are a lot of the questions you're gonna get. And sometimes you're gonna respond, trust me, it's a good deal, but that doesn't work. In a frothy market, it could, but in this market, it kills you. Those investors aren't just underwriting the property, they're underwriting your ability to operate under pressure times like we're in right now. Example number two, sponsor looks legit on the surface, great website, great marketing, great branding, clean pitch deck, but then you look closer and it's sloppy where it matters. The story in the marketing doesn't match the numbers. The risk section is basically two sentences, the offering terms aren't clearly explained, the structure is unclear, you don't know who you're investing with, the sponsor's communications are inconsistent, they use legal documents that were drafted by AI, and if it's messy now, they're thinking it's gonna be messy when it gets hard. So they're gonna pass. Not because the deal was bad, but because it doesn't feel professional and it doesn't feel fundable. Now, if you want to know whether your raise is set up to win in this market, here's a simple checklist that every single fundable deal has. Number one, a clear raise narrative and story. Who this is for, what problem it solves, why now, why you. And if you can't explain the deal in one sentence, you're asking investors to do the work for you, and they're not going to do it. Number two, a real investor fit. Most sponsors try to raise from everyone, and that's why their marketing sounds generic. You speak to everyone, you speak to no one. You need to know, are you selling to yield investors or growth investors? Accredited or sophisticated? First-time investors, experienced. When you try to speak to everyone, you connect with absolutely nobody. Focus. Number three, pre-launch momentum. This is massive. Most raises fail before they begin because the sponsor launches ice cold. You want soft commitments, interested investors lined up, frequently asked questions pre-handled, objections addressed, a when we open, we're already moving feel. Momentum creates trust. Number four, operator credibility. This isn't just years of experience, it's clarity among roles, responsibilities, decision-making, reporting cadence. Investors want to know you're not improvising the business. Number five, compliance that supports confidence. This is where a lot of sponsors accidentally step on landmines. Compliance isn't just about not getting in trouble, it signals seriousness to your investors. When your structure and your communications are tight, investors relax and investors invest. When they're sloppy, investors sense risk, even if they can't explain why. Here's the blunt truth. In this space, the capital raising space, close enough can be very expensive and it can get you in a lot of trouble. You still might be able to raise a little bit of money, but you're not gonna optimize your raise. You're increasing the odds of rescission risk, investor disputes, lawsuits, regulatory issues, or your deal's blowing up mid-raise because someone asked a question you weren't prepared to answer. And here's the kicker. You usually don't find out you did it wrong until you've already been successful. And that's when people pay attention. So here's the reframe I want you to walk away with. If your deal isn't getting funded, don't ask, what's wrong with the market? Ask, what's unclear about me, my structure, and my message? Because when you remove uncertainty, capital moves and capital follows you, even in bad markets, especially in bad markets. This is exactly what I do with sponsors, not just make things legal, but make them fundable. And I'm not your typical attorney who hides behind no. I'm here to answer how, not if. Risk is part of the business. My job is to tell you what the risk is, what the rules are, and what the liabilities are, so you can make an educated decision based on your risk tolerance, and then actually get the deal closed. I'm in this for the long-term relationship. I move fast because slow kills deals. And if you want to stop guessing and start raising capital with a real system, structure, strategy, and compliance that supports trust, that's what I help with. If this helped, please subscribe. On this channel, I break down capital raising, funds, and syndications in plain English so you can raise confidently and actually close your next deal. See you on the next one.